Have you ever heard the saying, history repeats itself? It's a comforting idea, one that suggests if we can understand the past, we can predict the future. After all, if certain patterns happened before, they'll likely happen again, right? But what if I told you that believing past patterns will always repeat could lead you down a dangerous path of false confidence? Let's break down why relying on historical patterns as foolproof predictors might not be as reliable as we think. Humans have always been pattern seekers. We love finding recurring themes and correlations. It's a natural instinct that helps us make sense of the chaos around us. In finance, for example, traders and investors frequently look for historical patterns, like market cycles or the famous head and shoulders chart formation, to predict the next big move. But why does this allure of historical patterns hold such power over us? We tend to overestimate the likelihood of past events happening again, especially when they match patterns we've learned to recognize. This bias can lead us to ignore critical changes in the environment or market that could invalidate those predictions. While past patterns can provide insights, they're not infallible blueprints. In fact, relying solely on these patterns might blind us to the unpredictable nature of real-world events. Now, let's dig deeper. Think about major historical events like the 2008 financial crisis or the COVID-19 pandemic. These were world-altering events that no amount of pattern recognition could have accurately predicted. In fact, many of these moments were unprecedented in the scope of their impact. While historical data can give us context, it can't always predict how the next Black Swan event will unfold. For example, a global pandemic wasn't something anyone could have expected just by looking at past market behavior or historical data. Market conditions and human behavior evolve. The same economic forces that drove past trends may not be the same today. The global financial system has transformed with technological advancements, social changes, and different political climates. Take a look at how technology has reshaped trading. High-frequency trading, algorithmic strategies, and even social media-driven movements like the GameStop short squeeze have radically changed market dynamics. These modern shifts make it even harder for past patterns to predict the future. The biggest danger of over-relying on historical patterns is that it creates a false sense of security. Traders, investors, or even regular people may think they've cracked the code because they've identified a pattern. But this can lead to significant losses or poor decision-making when the pattern doesn't hold up. When you believe that past patterns will always repeat, you're essentially gambling. History doesn't always tell us exactly what's coming, and in markets, no two situations are identical. So, what should we do? Should we abandon all historical data and throw out the concept of patterns altogether? Absolutely not. Historical data is valuable, but it should be treated as just one tool in your toolbox, not as the only tool. The key here is adaptability. The best traders, investors, and thinkers embrace uncertainty and focus on building flexible strategies that can accommodate new information, rather than relying on outdated ideas that may no longer hold true. In conclusion, historical patterns can offer useful insights, but they should never be considered foolproof. As we face an increasingly complex and unpredictable world, it's crucial to balance pattern recognition with adaptability, constant learning, and awareness of emerging risks. Remember, history may not always repeat itself, but it can certainly inform the decisions we make today. If you found value in this video, don't forget to like, share, and subscribe for more insights into navigating the complexities of finance, markets, and decision-making. Stay informed, stay adaptable, and never stop learning.